What exactly is side pocketing? In the context of mutual funds, side pocketing refers to the practice of separating illiquid or distressed assets from the rest of the fund's portfolio. Essentially, it creates a side pocket within the fund where these assets are isolated. Think of it like this: if a mutual fund is a big basket of different investments, side pocketing is like putting certain items into a separate compartment within that basket to keep them apart from the others. So why do funds use side pocketing? It mainly comes into play during times of financial distress or when specific assets become highly illiquid. This helps in several ways. 1. Protection of investor interests. By isolating the troubled assets, the fund can protect the interests of the remaining investors. The valuation of the main portfolio remains unaffected by the illiquid assets. 2. Better management. Fund managers can focus on handling these problematic assets separately, without impacting the overall fund's performance. Now, let's break down how side pocketing works in practice. When a fund decides to side pocket certain assets, here's the process. 1. Identification. The fund manager identifies the assets that need to be side pocketed. 2. Segregation. These assets are moved into a separate subaccount within the mutual fund. 3. Separate NAV calculation. The net asset value, NAV, for the main portfolio and the side pocket are calculated separately. This ensures transparency and accuracy in the valuation. It's important to note that once assets are side pocketed, investors can't redeem or purchase units from the side pocket. They can only deal with the units from the main portfolio. Like any financial strategy, side pocketing has its advantages and disadvantages. Let's take a look. Pros. Protection of main portfolio shields the main portfolio from the volatility of distressed assets. Focus management allows fund managers to specifically address and potentially recover value from illiquid assets. Cons. Liquidity issues. Investors have limited access to the side-pocketed assets until they are liquidated. Complexity adds an extra layer of complexity to the fund's management and reporting. To give you a real-world perspective, let's look at some examples. During the 2008 financial crisis, many mutual funds used side pocketing to manage assets linked to subprime mortgages. More recently, during the COVID-19 pandemic, funds with exposure to certain distressed sectors also employed this strategy. So, what should you as an investor keep in mind about side pocketing? Here are a few key takeaways. 1. Stay informed. Always read the fund's prospectus and stay updated on any changes or side pocketing decisions. 2. Assess the impact. Understand how side pocketing might affect your investment's liquidity and returns. 3. Long-term perspective. Remember that side pocketing is often a temporary measure aimed at preserving value in the long run. And that's a wrap on our overview of side pocketing in mutual funds. We hope this video has clarified what side pocketing is, why it's used, and what it means for you as an investor. If you found this video helpful, make sure to like, subscribe, and hit that notification bell so you never miss an update. Thanks for watching, and happy investing!